All right, today's webinar is going to be about getting started in multifamily investing. So we host our group, Multifamily Investor Nation. We host meetups across the country. We have over 50 meetup groups right now that are meeting every single month across the country. And we have co-organizers that are set up in these various locations. And when you go to the webinar registration page here, which for those of you who are on the recording, you can, in the comments or whatever, not in the comments, but in the description, there'll be a link for you to register for some of our webinars. And you just go to multifamilyinvestornation.com/MFIN webinar. And at the top here, you will see some of these different places that you can actually connect with us and be a part of the event. But if you go to meetup.com and search for Multifamily Investor Nation, you'll see some of the groups that we have. And I can probably pull them up here as well. Let me see if I can pull them up. Here we go. So we have 53 meetup groups in 2 countries with over 12,000, almost 13,000 members across the country. So go to this link and I will type it into the box here for those of you who are on live, and you can be a part of, all of, you can join a group near you. And if there's not a group near you, you can let us know. And we're always looking for new co-organizers for various parts of the country. So feel free to reach out to us about that. So but today is all about getting started in multifamily investing. And the reason why I decided to do this today is because there are a lot of people that join our meetup groups and they don't really have a basic understanding and knowledge around a lot of things around multifamily investing. And so to help us, I wanted to do this webinar because I am recording it and I wanted to be able to give it to our co-organizers to be able to give to new people that come into their fold, into their meetup groups every month, to have a better understanding of multifamily investing so they get more value from the event. So, but I want this to be interactive. So I want you to ask questions as I go throughout this. We do have quite a bit to get through. This is a lot of information to get through in just a short period of time. And so the first thing we're going to be talking about is what is multifamily investing. We're going to go through some common terminology to understand. I kind of cherry picked some different terms that we need to be able to discuss here. We're going to talk about how to fund your multifamily deals, the debt side as well as the equity, and then also understanding the asset classes, A, B, C, and D, the classification system there, how to present offers, how to find deals, and then have a discussion around high and low cap rates and which one is actually better. And then also how to effectively manage your assets. And then as usual, I like to kind of ad lib and add a bunch of different things in here and would do that as well. And so a couple of, I had Shellin in here, or Shalon asked me about how they can get involved with the meetup groups. And I'm going to give you an email address here on the screen, on the thing for everybody or anybody who's interested. If you're interested in being a co-organizer, whether it be a co-organizer for one of our existing meetup groups, because we always like to have at least 2 or 3 in each group, or if you're looking to start your own in your own city, then you can email Stacy, S-T-A-C-E-Y, at multifamilyinvestornation.com, and she can provide you with some more information on these different meetup groups and then be a part of it. There's a lot of benefits to being a co-organizer, and she can discuss those with you when you get to that point. So let's go ahead and dive right into this. So what is multifamily investing? So multifamily is obviously, multi meaning many, and then family meaning, a family of people or a family of properties. And multifamily really meaning, there's multiple units on a property. And the minimum could be 2, right? 2 or more units. But when you start to talk about apartment syndication, which is really a type of multifamily investing where you syndicate or you bring together multiple individual investors into one project to be able to acquire the asset where you might not otherwise be able to. That's apartment syndication. And again, they're very similar as far as multifamily investing and apartment syndication, but apartment syndication is really just kind of a subset of multifamily investing. But when you start to get into apartment syndication, where you start to get the biggest benefit is when you have 5 or more units. And for most cases, when there's apartment syndication, because of some of the fees with the securities registrations and things like that, which sounds complex, but they definitely can be done. And if you do it the right way, can be done, are typically, 100 units or more. depending on the price. So I usually like to say, minimum probably, 5 million in acquisition. But our group itself, our group passiveinvesting.com, looks for minimum 20 million or more right now. And so speaking of our passiveinvesting.com group, you can go to passiveinvesting.com. You can see the webinar. You can see the address here on your screen. I'll also type it into the chat box for those of you who are watching it live. But you can go to passiveinvesting.com if you're interested in investing passively or having that conversation with me and one of us. We have 3 partners in our group. You can go to meet the team to kind of learn a little bit about each one of our members of our team, and also go to the properties here and see the properties that we have actually acquired. So you can actually see those for yourself. And then on the right-hand side of the screen is just join the passive investing club. And so if you're interested in possibly passively investing with our group on some of our future projects or opportunities, would love to have that conversation with you. And you can certainly fill out that form and I can jump on a phone call with you regarding that. So the next thing here is about common terminology. So I wrote down several different terms that you should understand. And these are not all of them, but these are kind of like a baseline knowledge of what you should actually understand when it comes to multifamily investing. And so the first one here is going to be about, and again, these are not in any particular order, if they're not, higher importance or lower importance, depending on how I'm actually talking about them. I just kind of wrote down several of these. So you have to, as an investor, understand the difference between an accredited investor and a non-accredited investor. And so in many of these offerings that you're going to be doing, there's 2 different types primarily that you'll look for. And it's going to be a 506B as in Bravo or a 506C as in Charlie. And these are all exemptions within the SEC that allow you to do allow you to raise money from private investors, from high net worth investors. And so inside of each one of these, you have to understand the differences between those 2 things. I did a webinar on 506B and 506C, so you can go to our YouTube channel and search for securities and see that webinar that we did on it. But for this particular conversation, an accredited investor is an investor that meets one of 2 requirements. So they either have to have at least $1 million of net worth, or they have to, and that does not include their primary residence. So $1 million of net worth that does not include their primary residence, or they have to have an annual income of $200,000 for the last 2 years, or $300,000 if they're married, of annual income for the last 2 years, and they have a reasonable expectation that it should be continuing that year. So those are the qualifications to become accredited. You don't have to, go get your CPA to do anything or anything like that to be qualified as an accredited investor. Now, depending on which registration you do, that you actually invest under, then there might be some additional things that you have to do to try to verify that you're an accredited investor, but it shouldn't cost you a lot of money. It's usually a very easy, simple process to be able to do that. So that's what an accredited investor is. And of course, a non-accredited investor is somebody who doesn't meet those qualifications, right? But they, in order to invest in these types of assets in a syndication, they have to be sophisticated, which means they have enough knowledge in business and finance and real estate matters that allows them to be able to understand the risks and the merits of the investments that they're getting into. And so it's a very vague definition of sophisticated investor, but they do have to be sophisticated if they're going to invest if they are non-accredited. Now, I also wanted to talk about 3 different fees that we're typically charged. And Aaron is asking us here, is this live or pre-recorded? So I guess that answers your question, Aaron. This is a live webinar. Obviously, if you're watching the recording on YouTube, it's not live. But yes, I am live. So if you have questions, I want you to make sure that you type them into the chat box there. So there's 3 fees we're going to look at. So one is going to be the acquisition fee, and then there's going to be the asset management fee, and then the disposition fee. And so the acquisition fee is typically anywhere between 1 to 3 to sometimes 4%, depending on the size of the asset and how much difficulty it is to try to acquire that asset. And then the asset management fee is typically the same thing, 1 to 3 to sometimes 4%. And then the disposition fee is usually 1 to 2% is what I usually see with that. The acquisition fee is a fee that is actually paid upon closing. So when we acquire an asset, when they close on that property and you first take it over, that's an acquisition fee and you get paid that on closing. The asset management fee is usually a fee that's paid out ongoing to the manager of the property, to not the property management company, but the actual manager or the sponsor or the general partner to be able to manage that asset. And it's usually based off of the overall gross income of that property on a monthly basis. And it's usually paid out monthly as well. Then there's also a disposition fee, and it can also be similar to what's called a refinance fee, whether you're refinancing or disposing of the asset or selling the asset. You'd have that disposition fee or that refinance fee, and you would get paid that for the work involved with actually closing that particular property. The next thing is capex. So you might have heard that before, but capex is are those capital expenditures. So it's the amount that is actually been set aside for renovating the property, and it's commonly known as capex. The other is the cap rate, or what's called the capitalization rate. The cap rate is something that is fairly well misunderstood, in my opinion. I think a lot of people don't really use the cap rate properly. They use it a little bit. They're told one thing in education where you want to always chase after a certain rate, and we'll talk about that here in a minute. But the cap rate is basically a rate that allows you to know how much return you would make off of that property if you paid cash for the property. So if you have a 5% cap rate, then you'll be making 5% on your money if you just paid cash for the property with no debt and no leverage. Now, in most of the situations, you're going to use some sort of debt financing, leverage, something that will allow you to be able to juice those returns even more, because that's where debt actually is beneficial, because you'll be able to leverage part of it, and your debt's always cheaper than your equity, and so you'll be able to have higher returns when you use debt on these types of acquisitions. The next thing we want to talk about is the occupancy rate. And I know for most of you, you probably understand that occupancy is how many people are actually in your properties, right? But we also want to break it down even further and understand the differences between physical occupancy and the economic occupancy. So the physical occupancy is how many people are actually occupying your units, the physical people, right? How many of the units are actually occupied. And the economic occupancy is how many people are actually paying for the property. So you typically base that economic occupancy off of the GPR, the gross potential rents. So the total amount your entire property will actually get if it's fully occupied 100%, and you're achieving the market rents for your property. And that's important because in some of your lower end properties, your C class, D class, or even in your lower end B properties, you're going to see that you have a very high occupancy. But if you take a deeper dive into the T12 and the rent roll, you'll notice that the economic occupancy is much lower. So you always want to make sure that you're taking a look at that, and don't just take the word for it that it's 95, 97% occupied. Go dive deep into the numbers and figure out what is the actual economic occupancy for that property as well. The next thing we want to talk about is the GP versus LP. So the GP is the general partners. It's also called the sponsorship team or the management team. And then there's the LPs, the limited partners, or the passive investors. And there's usually a split, an equity split, when these types of deals are put together, where the general partners will get a certain percentage. So for example, in our projects, we do a 70-30 split. So 70% of the deal is given to investors, and then 30% is given to the sponsorship team. And so there is that GP LP split as far as the equity is concerned. Now, another thing to keep in mind is when you start to look at these different splits, there is also what is called a preferred return. And the preferred return is a preferential treatment of the investor's interest before the sponsorship team. So for example, if there is a 8% or a 7% preferred return, then the investors will get 100% of the cash flows or the proceeds, depending on how your project is set up. They'll get 100% of the cash flows up until that 7 or 8% preferred return. And then everything else after that splits, usually 70-30 or something like that. And so that would be that preferred return. And for me, I'm personally invested in right now in 19 different syndications across the country. And so I get an idea as to, what different operators are doing. And I would highly encourage you to invest only in preferred return properties. And so as a syndicator, if you're getting your business started or, kind of looking into this, you always want to make sure that you have those preferred returns. Because to me, it's one of the best ways to make sure you're protecting your investors. Because to me, our group is not looking to have just one investor invest in just one project. We want our investors to invest in all of our projects if they can, and they have the ability to. We want them to be with us for many, many decades, not just a one-off project and a one-off deal. So the next thing here we want to talk about is the PPM, the private placement memorandum. So the private placement memorandum is the document that includes a lot of the disclosures that the SEC requires us to disclose to our investors. So it's similar to a prospectus, if you will. But these PPMs, the private placement memorandum, will include the disclosures as well as the operating agreement, the subscription agreement, and then also information in there about distributions, investor questionnaire, and various things like that. So I would encourage you to, take a look at some of these. There's some people that if you wanted to, you can reach out to and ask for those, and they can give you an idea as to what they are underneath there as well. So Haley has a question coming in from the live audience. Are these syndication deals only for accredited investors? So Haley, that's a great question. And I would say that it really depends on the operator and which classification of the SEC exemption they're actually using. So in our projects with our group, passiveinvesting.com, we only do, right now, we're only doing 506B as in Bravo, which allows us to accept up to 35 non-accredited investors. And so usually with our projects, those spots fill up fairly quickly. So we always want to make sure our investors, let us know right away if they're wanting to invest, because they do fill up quickly. But we only have 35 spots available for those non-accredited investors. But as an accredited investor, we can accept unlimited accredited investors into our projects, whether it be a 506B or a 506C. But that's a very, very good question. And for those of you who might have missed it earlier, I did go to the front here and type in this passiveinvesting.com, and you can actually see some of our properties that we've acquired, and you can kind of see our portfolio and our team and stuff like that. And if you're interested in joining us on some of our future properties, and you can certainly do that, just click on that Join Passive Investing Club button, and it will bring you to a page that will allow you to put in your information, and then I'll personally jump on a phone call with you and discuss your goals and see if it's the right fit for you. So the next thing here is going to be, we're going to talk about active versus passive investors. So an active investor is somebody who wants to put together these projects, put them together, and actually be the main operator or the GP on a project. A passive investor is going to be somebody that says, it sounds like a lot of work. I really don't have a lot of time to be able to mess with that, or I don't want to spend a lot of time to do that. I'd rather spend more time with my family and do some other things that I want to do. And so they choose to passively invest. So they'll find somebody like us at passiveinvesting.com to actually invest their money with them, and they can sit back and enjoy the actual returns on those properties instead. So Frenchie's asking, is it difficult to syndicate the funding? And so we'll talk about that a little bit here in a minute, Frenchie. So just stay tuned for that for just a short while. The next thing we want to talk about is well, we'll talk about that in just a minute. I'm just going to talk about the LOI. We'll talk about the LOI when we talk about in a minute here, this section here about presenting offers. So we'll talk about that in a minute. The NOI stands for the net operating income. So this is the income off the property before you pay for your debt service or your mortgage, your principal and interest on your mortgage. And so this is going to be the amount where you take your overall gross income and then you take out your expenses, and that's going to be your net operating income of the property. And this is important because that's how you determine what your purchase price is when you actually know what the market cap rate is in your market as well. And so the IRR is the next one I want to talk about. And many of you have probably never heard of the IRR before, the internal rate of return. And it's very similar to the ROI. And so for those of you who are watching live, I want to do a quick exercise. So get your chat box open, and I want to ask you a question. I want you to answer this question inside the chat box. So for those of you who or if you took $100,000 and I told you I invested $100,000, I'm going to switch it a little bit. I took $100,000 and I invested it inside of a property or inside of an investment, and I put $100,000 in and I got $300,000 out. Is that a good investment? So in the chat box right now, tell me yes, no, maybe, I don't know, whatever your answer is, yes or no. I put 100,000 in and I got 300,000 out. Is that a good investment? So type it in now. I'll give you a few seconds here. Here I have yes, over what time frame? Yes, 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 yes. It depends. Yes, depends. Yes, yes, depends, 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 depends. And so we're not talking about diapers here, right? Not the depends diapers, right? We're talking about, yes, it really depends, because one thing that ROI does not bake into it is time, right? So you have to understand the time of how long it actually took you to get that investment back. Now, when you start to talk about short-term investments, whether it be like a fix and flip or some hard money, things like that, they don't usually talk about IRR, okay, the internal rate of return. But what IRR does is it bakes into it the value of the time that your money is involved in that. So it's called the time value of money, right? And so it's a weird long calculation that's hard to do by hand, but there are Excel formulas that you can use on it. You can also Google internal rate of return calculator to be able to understand it further, but it actually allows you to see a truer picture as to what your actual return is based on the amount of time that somebody is holding on to your money. So it gives you a better understanding of that as well. Obviously, the T12 and the rent roll, the T12 is the trailing 12 months of expenses. You might also hear T3, T6, T1, T2. Those are all just basically saying the trailing expenses, and then that number following it is the number of months that they actually have a historicals of that trailing on it. So that's going to be the T12, and then the rent roll, or abbreviated RR, is going to be the rent roll is basically a list of all of the names and the units and the properties. I mean, and the rents that people are paying, whether there's amenity rents or pet rents or whatever the case may be. And then it also includes expiration dates on those as well, which is very, very important to be able to make sure you're taking a look at that when you're underwriting or analyzing a deal. And that's the other term I was going to talk to you about, is underwriting. You know, a lot of times we think of underwriting as being for like insurance, or when you're acquiring a single family home and you have an underwriter looking at things. That's what you're going to be doing as a multifamily syndicator, is underwriting or analyzing, financially analyzing, looking at these different properties to see if it actually makes sense from a return perspective for you and for your investors. So that's a very, very key thing to be able to understand, and it's very, very important, is the underwriting. The next thing is the rent comp. So I have two more after this, and then I'm going to finish up from the terms and talk about some of the funding side of things. So the rent comps. The rent comps are the properties that are surrounding your property that are similar in age and makeup. They may have already been renovated, and this one, yours, might not be renovated, but it gives you a better understanding as to what other people in the market are actually charging, to see if the property you are acquiring is under market, or maybe it's at the top of the market. But it gives you a better understanding as to where your property lies. And those are the rent comps. And then, of course, you have your value add terminology, which is basically stating that you are acquiring a property that has some form of value add. It means you're going to add value in some form or fashion. And there's two ways to affect the NOI, that net operating income. We talked about that NOI earlier. So the way it's calculated is you take your overall gross income and you take out your expenses. So there's two ways to affect and increase that NOI. You could either increase your income, which will increase your NOI, or you can keep your income the same, but operate the property more efficiently and decrease your expenses. And that, again, increases that net operating income. What most people like to do, like our group, is we like to try to affect both of them. We want to increase the income and also decrease the expenses by running things more efficiently and then in a more effective manner. And so those are what you're looking at when it comes to value add. And the way you increase the income is you typically adding some form of amenity to the property, whether it be, value added in, some form of like valet trash or RUBS. And RUBS is another one of the terms I wanted to talk to you about. RUBS is an acronym that stands for Ratio Utility Billing System. And there's usually services that will help you with that. And it helps you bill back the utilities to the residents if for some reason they're not already doing that. And so that's that RUBS side of things. That's another value add piece to it. But then also doing interior renovations and upfitting the exteriors can all allow you to be able to increase the rents to the market rents based on that competitive analysis from those rent comps that we talked about earlier. So the next thing we're going to talk about here is how to fund your multifamily deals. And Frenchie, this will help you understand a little bit as well on this, since you had asked a little bit of a question on here about how to fund them. We're going to talk about it from the debt side of things as well as on the equity side. So from the debt side of things, you're going to be using one of two things typically. You're either going to be using some form of I guess I'll say three things. You're either going to use if it's a smaller property, you're going to use probably like a local bank of some form or fashion, or you might use a bridge lender, which is somebody who actually can still finance your property, but a bridge lender kind of gives you that bridge of financing between the time you acquire the property until the time you would put it into some form of permanent debt, which might be agency financing, the Fannie Mae or Freddie Mac. And from that would be the third one, is the agency financing, some permanent agency debt with either Fannie Mae or Freddie Mac. And you would put that on the property. Typically, Fannie and Freddie want to see at least a minimum of about 1.25 to 1.5 as far as the loan balance. So you're looking at closer to about probably about $1.5 million to $2 million property before you can actually do that. But there are a lot of different companies out there. If you actually go to our page here, the Multifamily Investor Nation Summit, you'll see there's actually a lender right here, this Hunt Real Estate Capital. If you click on their link there, it'll bring you to a page where they actually have lenders in all 50 states. Lenders, but they have people that are able to lend in all 50 states, and they do mostly small balance work. So anywhere between 1 million to 7.5 million, that's what they do. And they also have a conventional team that also does over 7.5 million, but they are really, really good at these small businesses as well. And so again, they like those transactions between 1 million to 7.5 million, and you can easily fill out that form. They'd be glad to help you out there. I have not done a deal with them, so I can't vouch for them myself. But that's just something I was thinking about when it came to these different types of funding options. So that's from the debt side of things. It's usually fairly simple to be able to do that. There are usually certain requirements that are in place in order to get debt on these properties. So you have to have net worth of the loan balance. There's usually three things that you have to have. You have to have net worth of the loan balance, and that can be aggregated between all of the members of your general partnership. It does not just have to be one person. And then the second thing you have to have is liquidity. And the liquidity, which is basically just cash sitting aside, you have to have liquidity of at least 10% of the loan balance. And so every lender is going to be a little bit different. Shalon saying, or a real rich KP, a key principal. So yes, you can have one person do all of it as well. So it just depends on who you have on your team. And so that's the two requirements, is the net worth and liquidity. And then the third one is experience. They want to make sure that they're going to give this kind of money to somebody to operate the property, that they have somebody on that operations team that actually has done it before and has some form of experience and background in managing these large types of budgets. So those are the kind of the things that you have to know from a debt's perspective. The equity side is going to be where you're going to be finding your investors. So your LPs that we talked about earlier, those limited partners that you're going to bring to you and to your project and be able to get them to invest in your property. And so those are going to be found in a lot of different ways. Usually, first off, most people are going to go through their friends and family that actually know them. And then once they build their credibility and experience with doing friends and family, or if they join another general partnership and join them and partner with them, then they can leverage that experience to be able to build their credibility, so that when they're ready, they'll be able to acquire some of their own assets together. And so those investors are going to be real really it's all about networking and getting in front of people and being personable. One of the reasons why I do a lot of the things that I do is that I want to make sure that people know about me. And so a lot of it's about being aware of somebody. And there's a big thing that I always talk about, which is know, like, and trust. And in order for an investor to invest in you, they have to know, like, and trust you. And I'm going to do another test here. So for those of you who are watching live, go back to your chat box here. And of that triangle, I call it, of know, like, and trust, which one, type it in now, would you say is the most important? Know, like, or trust. So type it in right now, type in know, like, or trust. Of that triad, before somebody is willing to invest with you, what is the most important? Know, like, or trust. And so the first one here is no, and then I have trust, 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 trust. And I have like at the end, and I have trust again. And I'm going to blow all of your minds except for one person, and it's no. And even though trusting somebody and liking somebody is very important, but the knowing somebody is actually the most important, because if they never have an opportunity to know you, then they never have that opportunity to actually make a decision and an opinion as to whether or not they like or trust you. And so they have to meet all three of those. But one of the things you have to get through your head if you're trying to raise capital and raise money is that people have to know you first so they can start to like and trust you. And so the more you can put yourself out there, the more they're going to be able to know you and make that determination of whether or not they like or trust you. Okay. And so make sure that you're always doing something and trying to build an authority platform or brand or something to be able to get people to understand who you are and to be able to know you. So that's from the debt and the equity side. The next thing is going to be from asset classes. So Shalon is saying here that they've heard me talking about this at the Dealmaker Live with Michael Blanc's group in 2019 here. I had that at the event, and it's always a big takeaway I think that a lot of people have, because we always kind of think that they have to trust us or they have to like us, and it's really kind of a game changer when you start to think about that know, like, and trust and realize, wait a minute, yes, not like and trust is important, but I got to get people to know me more. And there's ways for you to get people to know you. And you can even go to our YouTube channel and search for high net worth investors or raising capital. And you'll find some webinars that I've done on specifically about raising funds for these types of projects and these types of events. And so it can be, and it is very, very important. All right, asset classes. Let's talk about asset classes here. So we have these asset classes. We hear A, B, C, and D. And so your A classes, you want to think of those as kind of like the top of the spectrum, the best, the highest priced, usually the most amenities, and are the newer build properties. And on the opposite side of the spectrum is the D class properties. I would stay far away from D class properties as possible. We call that the war zone, if you will, right? So we want to stay away from those. And then in the middle there, you have your B class and your C class properties. So your C class properties are going to be your lower income people that are in those properties, your blue collar workers, and then your lower end B is going to be similar to that as well, but they might be a little bit newer properties. And then you also have your B plus properties, which might be 15, 20 years old, 25 years old, that have never been renovated. So there's still some opportunities for you. The sweet spot that we like to look for in our group is a B plus asset in an A class area. It just really fits very, very well, especially right now at this current stage of the market cycle, that's a kind of a sweet spot for the types of investments that we actually are trying to put together for our group, are those B plus assets. And so it's not necessarily just the type of residents that are in there, but it's also the age of the property. So again, those A class properties are, 10 to 15 years old. Your B class properties are going to be 15 to 20, 25 years old. And your C class properties are going to be, 25, 30 plus years old. And then your D class properties are going to be, even older than that. And so you'll see based on the area that it's in and how well maintained it is, that those asset classes can flux a little bit based on those years. That gives you a general understanding, as the A classes are going to be the nicer properties, and then it'll be the next level with the B class, and then the C class will be your lower properties, and your D class will be the ones you just want to stay away from. You don't want to be in those D zones, if you will. Now, what is the letter of intent? So now we're under this presenting offers phase. So the LOI is that letter of intent. And when you're talking about single family properties, most of the time when you're making an offer, you're submitting a contract and they're going to sign the contract and it's locked in place. The LOI is a phase that's actually done on some of these larger properties, which is basically just an understanding between the seller and the buyer as to what things they're going to put inside the PSA, because sometimes it takes a little bit longer to put those PSAs together. And so it usually starts with an LOI, a letter of intent saying, hey, this is what I'd like to purchase your property for. It is typically non-binding by the seller and the buyer, but it's really a document or a memorandum of understanding, if you will, an MOU, a memorandum of understanding, as to what's supposed to be inside the PSA, the purchase and sale agreement. But usually you're going to be submitting that LOI ahead of time to be able to submit your offer and let the actual seller know exactly how much you're wanting to purchase that property from. And let's see here, finding deals. So most of these deals that you're going to be finding are going to be through a broker. So that's one of the best ways to find them. And, yes, you can put some strategies together and find some off-market properties. If you go to our YouTube channel, type in, finding multifamily deals, you'll find a whole webinar that we did on different strategies on how to find some of these properties. But one of the number one ways you can do that is through multifamily brokers. Now let's have this conversation here. Actually, this is going to be a question. Let's tackle this one last. This is, which is better, higher or lower cap rates? And so let's first tackle this question here first, how to effectively manage your assets. And so one of the things that I like the most about multifamily assets is that we can use third-party property management companies to actually manage our assets. And they can also be they can also be living on the property. And so it's really, really nice with these multifamily assets because you can have on-site people. Typically, you're going to have at least probably 60, 70, 80 units at a minimum in order to have at least one person on site. But once you get over to 100 units, you're usually going to have 2 to 3, sometimes 4 people on the property, depending on how much is actually needed to be done on that. And then you'll hire a third-party property management company to be able to manage the asset. And so as the general partner, your responsibility is to be managing the manager. And so what you have to make sure you're doing is making sure that they're actually performing based on the projections that you actually set out on your underwriting and when you analyze the deal initially. And so we rely on those property management companies very heavily. And if you go to our YouTube channel, you'll find, you can even on our page here, you can actually click on this, which will bring up the YouTube channel. On the YouTube channel, you can actually find let me pause that for a minute. Under these prior live webinar recordings, you can actually find in here some of the other things that we've done as far as, how to actually vet a property management company and ask those questions. And all of these prior webinar recordings that we've done are actually on here. And so you can certainly do that. But here you go right here, top 10 questions when hiring multifamily property management company. And so this is a webinar that you can listen to that will give you some information about how to actually find these property or vet these property management companies. And I'm going to type in here for those of you who are watching live. If you want to click on that, that'll give you that access to that video, the top 10 questions to ask when hiring a multifamily property management companies. All right. And let's see here. The last thing I want to go over today is this which is better, high or low cap rates. And I know I've covered a lot today, but this is going to be a very important topic that I want everybody to listen up and understand. Okay. Because it'll be something that'll be a game changer for you, especially if you've done any research or done any educating in regards to multifamily investing at all. And so we already talked about what that cap rate is, or that capitalization rate. But for those of you who are watching live, I want you to type in there and tell me what your opinion is. Just tell me high or low, which one you think is better, high cap rate or low cap rate. And I will tell you that there's not really a wrong answer, but which one would you say that you prefer, a high cap rate or a low cap rate? So type it in now. And if you don't know, type in IDK for I don't know. And that's okay, because, if you're first getting started in this and you're not really sure, it's okay to not know, but it's just not okay to not continue to not know, which I'm going to help you today so you can actually understand exactly why you should be doing either a low cap rate or a high cap rate. So let's see here. We got low, I don't know. Depends on if you were buying or selling. That's true. I guess we'll say both, right? And then Rama's saying low. We got high, low, We got high, depends, low, depends on the area. So a lot of your multifamily educators, which I'll tell you right now that, I do a lot of these webinars, but I don't have a coaching or a mentoring program. So you can go ahead and put your guard down a little bit, right? I always tell people that I don't have the time for it, nor do I need the money. So I don't do any type of mentoring or coaching, but a lot of these gurus out there, I've heard them teach people to try to find high cap rate properties to buy. And they're talking about buying these 7 or 8% cap rate properties. And I'm sitting there going, why would I want to do that? And so in my opinion, it's better to go after these lower cap rate markets and these lower cap rate properties. And I'm going to give you an example as to why. So if I have the same property, let's just hypothetically say we have the same property in a low cap rate market and the same exact property in a high cap rate market, everything's the same, right? But I acquire the property, and one's bought in a 5 cap market, one's bought in an 8 cap market. I spend the same amount of time, energy, and effort increasing the NOI, the net operating income of that property, by $100,000 on the 5% cap rate market, and a same thing, $100,000 on the 8% cap rate market. I actually have a higher valuation on my exit in that lower cap rate market. So in the 5% cap rate market, I've increased the value of that property by $2 million. So you take that $100,000, you divide it by 0.05, and that's going to give you that $2 million increase in valuation just from that one $100,000 NOI bump. On the 8% cap rate market, you do that same calculation, 100,000 divided by 0.08, and you've only increased the value of that property by 1.25 million. And so you can see the difference between that time, energy, and effort on which one that you would really want to focus on. And I think that the lower cap rate markets are, for me, a litmus test as to how strong that market is. If I'm buying in a higher cap rate market, that means that the market's not as strong. And so in order to attract people to buy in that market, they have to sell it at a higher cap rates. So the higher the cap rate, the lower the sales price. The lower the cap rate, the higher the sales price. And so yes, in the beginning, you're going to be paying a higher price for it, but when you do your value add play and you exit that property, you'll be able to exit it and have a stronger exit as well. Now you might think about it and go, well, if you buy in a 5 cap rate market, you're probably only going to be able to exit a 6% cap rate. And but I would argue and say, but yes, if my 5% goes to a 6% because the market shifts, your 8% is going to probably go to a 9, 10, or an 11, depending on how things go. And so yours is actually even much worse, because now your 100,000 is less than $1 million in increase in valuation. So that's one thing I wanted to talk about, because to me, buying in those low cap rate markets is a much better strategy, whether you're buying or selling. Because if you're buying in a high cap rate market, guess what? You're going to only be able to sell pretty much in a higher cap rate area. And so if you buy in a low cap rate market, your chances of selling that in that low cap rate market is very, very good. So buy low, sell low as far as the cap rates are concerned. Now, that's all I have to cover today. Hopefully you guys were finding a lot of value with the webinar today around getting started with multifamily investing. Make sure that you go to the MFIN Summit page here, mfinsummit.com. Register for the summit coming up on January 16th, 17th, and 18th. It's an all online, incredible event. Do it right now. I'll type in again for those of you who are watching it live, I'll type into the chat box here the website address, so you can go ahead and jump over there and register for it, and love to be able to have you there. And again, I'll give you my 100% money back guarantee with that. And for those of you who are watching this that is after the event, still go to the mfinsummit.com, because we'll have another one coming up in June 2020. And then twice a year, we're continuing to do this summit. So make sure you go to mfinsummit.com, register for the event. And it looks like I have 2 questions on here that I'll take before we wrap things up. I do have a few more minutes here that we can spend here. Shalon's asking, I am evaluating a B+ property and I am having a hard time getting my 8% cash on cash for my investors. So there's a couple of things that you can do there, Shalon. So number one, you can just pass on the deal and find one that does. Or number two, you can lower the preferred return for your investors. So if your preferred return is 8% and maybe you're only getting a 7 or 7.5%, you can lower that preferred return to 7%. If it's lower than that, you can obviously go lower, but you might miss out or lose out on some of those investors. So one of the things you can also do is raise some extra funds for extra operating reserves to actually fill that gap, to be able to get yourself to that 7 or 8%, to be able to make sure that you get those distributions available to your investors. And that way you, number one, are making a more conservative deal because you have extra in operating reserves, but then you're still able to hit those returns for your investors. So if you have some further questions about that, I'd be glad to jump on a phone call with you. If you have some further questions for me, you can always shoot me an email. If you have a question, my email is a simple email. It's just dan@passiveinvesting.com. And then Frenchie's asking about, what about syndicating the funding? So we do have, Frenchie, we talked a little bit about this already as far as the equity side of things, but as far as syndicating the funding side of it, you're going to syndicate the equity side. So the debt side is obviously going to come from a bank, whether it be local bank, bridge lender, or agency, whether it be Fannie Mae or Freddie Mac. Then the equity side is going to be finding investors to be able to invest in your property. And so I even did a webinar on presenting a deal to investors. I'm not sure exactly where it is, but somewhere in here, I did one called Presenting a Deal to Your Investors. And I talked through every single one of those strategies about steps to outsourcing technology. I know I did one recently picking inside of, I have to go to my YouTube channel and search for it, but inside of their YouTube channel there is a video on how to actually present your deals to your investors. And so if you go find that webinar, it'll talk a lot about those different pieces, but you can certainly, with the syndicating of this, you're going to either do it via a 506B or a 506C as in Charlie. And then typically a minimum investment is going to be $50,000, and investors will put their money into a bank account together to be able to acquire this asset. They will get a piece of the equity of that 70% that's available to investors. And there are definitely some softwares out there that can do this, that will help you make that a little bit easier. But you can certainly do that as well. I think that this one actually might be it. Steps to easily raise capital. Nope, that's actually a syndication company group. Let me see if I can find it in here real quick. It should be fairly easy to find. I'm not actually seeing it in here. But if you go to the YouTube channel and scroll through there, you should be able to find there's some steps to raising capital. So there it is in there. So raising private capital and how to actually do the syndications. And then there's actually another one in here from Multifamily Syndication talking about Regulation A versus Regulation D, and breaking down 506C and 506C and B registrations as well. So there's a lot of resources there on the website from our YouTube channel. And I encourage you to go there, subscribe to it, and be aware of some of the future webinars that we'll be doing around multifamily as well. So, all right. It says, Trey's asking, do you try to avoid markets where there are additional expenses like snow removal? So I would say that I don't personally like to invest in the north because of the snow. So any of those colder markets, because there are some additional expenses that are hard to budget for, because you might have one snowstorm or 10 snowstorms in a season. So it is a little bit harder to budget for those. So there are definitely some markets like that that I would want to avoid. Actually, at the Multifamily Investor Nation Summit coming up, there's actually going to be a gentleman, let me see if I can find the schedule down here to give you the topic. It's Neil Bawa. He's actually going to be talking about some of the different ways to be able to find good markets, or the markets for 2020. And so here it is, top 2020 real estate trends and challenges that affect your real estate profit. So that's going to be on Friday between 2 to 15 p.m. Eastern. We will record every session. So as a paid attendee, you will get access to that as well. We also have some panels going on, and we actually, one of the panels that is one of my favorites is this one, which is on Thursday. It's the state of the 2020 multifamily market. We've had these same gentlemen back. This is now their third time in a row talking about the various levels of multifamily and around the country for 2020 coming up. So it's a great one to be able to be a part of. And for those of you who want to join us, you can do that right now as well. So I know somebody was asking me for the website again. So I will type both of those in here again for you so you can actually get registered for the summit coming up. And then I'm going to go ahead and wrap this up and make sure that you are a part of our email list. So if you haven't gone to it yet, go to multifamilyinvestornation.com/MFIN webinar, register for the next webinar coming up. We try to do these every single week. We'll have another one coming out next week. Looking forward to sharing with you. And I hope you have a great, wonderful rest of your day. Bye-bye.